Hello everyone, and welcome back to the channel. Today, we're diving headfirst into a hot topic that's been spreading across both mainstream media and financial circles like wildfire, the current state of the US labor market. Economists are expecting some fireworks with the November jobs report, but is this just a temporary bump in an otherwise grim outlook? Buckle up, because the storm clouds gathering over the US economy will need more than a few good headlines to clear away. It's no secret that the jobs report is one of the most closely watched economic indicators, and wow, is this month's data coming at a crucial time. Let's not forget, the November payrolls report will drop just before the Federal Reserve's next policy meeting, and here's my big question: are we really heading towards a healthier labor market, or are we simply kicking the can further down the road? Now, let's cut through the noise and talk about why we're seeing the numbers the way they are, and why some people should be more worried than they seem to be. Coasting off the wreckage of October with its meager 12,000 job growth, thanks to some pretty nasty hurricanes and one massive strike, we're naturally going to see a rebound. After all, you can't choke 2 months in a row with factors like that, right? Economists polled by Bloomberg expect 220,000 new jobs in November. Sounds good, great even. But hold on just a second. Don't let these short-term numbers fool you. Deutsche Bank, Citibank, and Bank of America are all pointing out something key here: a huge chunk of that gain is just people coming back to work after being sidelined by storms and strikes. According to Bank of America's economists, we're looking at about 100,000 jobs of this increase as essentially payback for the turmoil in October. So, is this an indicator of real recovery? No, not really. It's the labor market catching its breath after getting sucker-punched by Mother Nature and labor disputes. In any case, investors should really buckle up for a situation where this burst fades away faster than anyone's holiday spending. One of the reasons we're all listening with bated breath to the Fed's whispers: the moving average job growth. This data makes it easier to see the underlying trend and cuts out some of this month-to-month static, disruptions, and market volatility. Economists' consensus numbers here are even more sobering. In November, we're expecting a 3-month moving average of just 151,000 jobs, which is a significant step down from the heady days earlier this year. In fact, we're seeing a declining labor market momentum. The once booming economy from 2021 to 2022 is now slowing as we shift into a more challenging macroeconomic backdrop. Everyone, hear me loud and clear. While the numbers in November may turn green on employment, the deeper trends are a clear signal of stagnation. And that's after the Fed has been hiking interest rates aggressively to knock down inflation. But there's this massive paradox: inflation should naturally slow down more, yet unemployment hasn't spiked the way many feared, or has it? More on that later. Let's talk about retail, the darling sector of the holiday season. Normally, retailers are falling over each other to bring on holiday staff, but economists like David Mericle from Goldman Sachs are not impressed. In fact, holiday retail hiring is down, way down. Mericle estimated that the traditionally late Thanksgiving and Black Friday have probably cut retail payrolls by about 15,000 jobs. And it gets worse. EY's Lydia Bussour lays down another brutal truth: this year's retail hiring plans are among the lowest we've seen since 2009. Yes, you heard that right. We are talking about numbers that mirror the aftermath of the great financial crisis. She even argues that seasonal factors may exaggerate the impact downward, meaning things could look even worse than what the raw numbers suggest. Retailers, possibly unsure of the health of consumer demand amidst higher borrowing costs and inflation, are playing it so safe that they're practically terrified. The broader worry here: the drop in holiday hiring likely hints at weakened consumer spending power for months to come. If I was sitting in a corporate boardroom, I'd be worried about this leading into Q1 2024. Consumers, crushed under inflation and high interest rates, simply aren't spending like they used to. Think of it like this: how are retail sales supposed to fly high if companies aren't investing in their workforce? Let's move on to a number that everyone loves to quote: the unemployment rate. It could hang tight at 4.1%, or, as some more cautious economists warn, we might see a tick up to 4.2%. Okay, so it's a small nudge higher, but hold on. The unemployment rate doesn't tell the whole story here. It's a facade if we look only at the headline numbers. Bloomberg's own economics team argues that the real pace of monthly job gains is barely positive once you scrub out all the noise, much lower than needed to keep unemployment from rising over the long term. Laid-off workers, and yes, even new entrants into the labor force like recent grads, are struggling to find jobs. Not all jobs are equal, certainly not in 2023. While technically one can argue the unemployment rate is stable, lurking underneath are long-term shifts that say this stability is fragile and unsustainable. The Federal Reserve would love for this number to rise gradually in line with its battle against inflation, but what if we enter 2024 with stagnating wages and weaker job creation? A slight labor market cooling post-pandemic we could absorb, but stagnation bordering on contraction, combined with high consumer borrowing costs. We could be sitting on a ticking time bomb. So, how does the Federal Reserve fit into this picture? Jerome Powell and his merry band of policymakers have spent months aggressively hiking rates, but instead of seeing the usual correlation between higher rates and skyrocketing unemployment, we've had stubbornly strong job figures stretching well beyond any expectations. Why? Well, the traditional, textbook, supply-demand mechanisms aren't as simple in post-COVID global economics. Don't get me wrong, prices for lots of goods are stabilizing somewhat, but core prices like shelter costs remain elevated. Labor supply is now being dictated as much by inflationary pressure on wages and the rising burden of credit card/loan debt as any deliberate policy intervention from the Fed. With service industries still demanding hires and workers leveraging their earning power to offset cost of living adjustments, we're seeing a unique mess. Economists might call it healthy for a slowdown, but this could just be the precursor to structural corporate layoffs heading into 2024. Nobody wants to say it too loudly, but we're threading a thin line. A short-term stabilization followed by abrupt layoffs next year could be in the cards, especially if GDP growth slows down beyond expectation. Let's also pull back and think globally for a minute, because make no mistake, the US isn't the only country facing market strains. China's economy is losing steam faster than anyone expected, with export growth significantly cooling down. Europe? Still suffering through high inflation and an energy crisis underlined by ongoing geopolitical issues. This reduction in global demand for US exports is bound to trickle back into the domestic economy. The bottom line here is that we're not just talking about a tight labor market being driven by temporary factors unique to 2023. There's evidence that headwinds, both globally and domestically, are piling up so high they could crash down as early as the next quarter. Here's the takeaway: it's tempting to look at November's upcoming hiring recovery and think we might be turning a corner. Sure, a pickup from October's mess seems like an indicator of resilience. But we cannot ignore the narratives behind the scenes, the issues in retail staffing, a cooling in real long-term job creation, the precariously low buffer in unemployment, and inflationary damage that wage gains and a hot labor market can't fix permanently. We've got massive external risks still hanging in the air: China's drag keeps expanding, Europe's energy and inflation crisis, and lingering Q4 worries on overleveraging in the US credit system. It's a house of cards, folks. And what happens when the wind picks up? As we move deeper into 2024, we could be witnessing the start of an economic slowdown that will be harder and harder to reverse, reminiscent of the 2007 to 2008 prelude. We're not sounding the doomsday alarm yet, but unless policymakers pivot away from headline distractions and start tackling the quiet crises already creeping from the shadows, we could be heading into serious trouble. Till next time, folks. Drop your thoughts in the comments, I'll be watching those closely.